My problems with long-term care insurance in a nutshell. This is going to infuriate you because it infuriates me. All right. So just for the record, for all you, I can't believe you don't like long-term care. I have it. I have long-term care insurance, amigos. I do. My wife and I do. You know why I have it? Because I have four kids. Well, I have three in the house, but four children. When I took it out when I was 37. I'm 51 now, so I've had it for 14 years. About 14 years, maybe 40. I've had it for over 10 years. Because I have a big fat mortgage, I'm the primary breadwinner. If my income stops for whatever reason, my wife and kids are destitute. No other way around that. When I say income stops, that means I'm still living. I haven't died. I'm still living, but I'm needing some kind of long-term care. Remember, long-term care is for caring, not curing, all right? Long-term and short-term disability are different than long-term care. Care, I was talking to a guy today, it should be end-of-life care as opposed to long-term care because it's not curing you. Long-term care means you're probably not getting better. The hospice, essentially, if that makes sense. It's not literally hospice, but at the same time, it's kind of that. Once you're going down the road of hospice, it's tough. And once you're going down the road of long-term care, you're probably not coming out. Anyway, so I have it because if something were to happen to this mush of coal up here, my wife would be in a world of hurt, and vice versa, frankly. So when the house is paid and the kids are out, I'll drop that like a ton of bricks. So I'm not anti-long-term care. However, many, many moons ago, when I used to be a broker and an agent, I had my life insurance, I had all that stuff, my life and health, I could sell all that insurance products. Genworth, and I never sold Genworth. I always liked the Lincoln Money Guard instead. Lincoln Money Guard was you pay a fixed sum in the front end. It gave you a small death benefit. You had guaranteed access to your cash if you want. You won't get any return on it, but at least you had the money there, and it gave you long-term care. Essentially, it's accelerated death benefit on the life insurance, but it still gave you long-term care coverage. Not a huge amount, but enough. Anyway, but there's always Genworth out there. Genworth, their sales literature, man. It said, hold on a second. I want to see if I can't find something. So this is an article from LA Times in 2008. The price hikes are not universal. And the three biggest providers of such coverage represent about 70% of the market, and they have shown restraint on premium hikes. Among the top three, for example, John Hancock and MetLife have never raised premiums on their policies. Genworth, the industry leader, recently applied for its first rate increase, which will average 10% and affect just under half of his current long-term policies. All right, so what they say, remember, this is 2008. This lady from John Hancock. Companies made the biggest errors in pricing have largely left the market. And that was Penn Treaty. Had a client who had a pen up in Monterey, Virginia. Freaking beautiful, man. Oh, Bath. I think it's that Bath County. I forgot. Oh my goodness, beautiful. Little Switzerland they call it. Anyway, had a client up there. He had a Penn Treaty plan. He bought in like 1996 or 7. It was freaking insanely cheap. Never raised premiums. Inflation adjusted. It was nuts. And of course, Penn Treaty proceeded to go out of business. I don't know what happened to his premiums or his policy, but man, it's nuts. Point being is they used to, Genworth, in this case, I'm picking on Genworth, I don't know if they used to advertise like with a brochure. I think they did, man. Maybe the wholesalers, but I think they used to have brochures that said, we've never raised premiums in the 15 or 25 years we've been in business. Yeah. So check this out. You ready? It's going to freaking infuriate you. So here's a client of mine. Hold on a second. Here's a client of mine, sends me this and said this would be a good video for you to do. You don't know who she is, obviously. Let's just put it this way. She's in her mid-70s, all right? A single lady in her mid-70s. Has long-term care. Has had long-term care for many, many moons. Here's her current benefits. She has cash. She has a maximum daily benefit, basically $280 a month, which is fantastic. Inflation benefit, 5% compounded annually. Elimination period, only 30 days. Benefit period, unlimited. Total lifetime benefit, unlimited. This is freaking nuts. Her monthly premium is $314. Now, that's a smoking deal. This is with Genworth, because remember, Genworth, we never raised premiums. 208. She lives in California, this woman. $280 maximum daily benefit. 5% compounded with a 30-day, basically, it's a deductible, essentially. You will never see this again. Benefit period unlimited. Total lifetime benefit unlimited. Completely. It's insane how good this is for $3,000 a year. All right. But Genworth is saying, we can't afford this. Yeah, you think? You think? So we're going to give you a couple options. One is we're going to raise your premiums by something like 400%. So some insane amount. I can't remember what I'm talking about, but some insane amount of money. Or you could take one of the other options. Reduce paid up benefits. So now you no longer have any monthly premium. And instead, your maximum daily benefit will stay the same, but there's no compounding, no inflation adjustment at all. You still keep your elimination period. Again, your deductible. Normally, elimination periods are 90 days. It's usually 110 for Medicare, but be it as it may. There's no benefit period. It's just we're going to give you this cash amount right here that you can get over the course of $279 divided by this amount right here divided by $279. We're not going to give you any more premium, though. So she had the freaking gold standard of benefits. I mean, this is insane. Or she could just say, no, I'm going to reduce all this. Instead, I'll have $101,000, which I can tap into, but it's not inflation adjusted at all. I'll get $279 a day. And as long as that money right there, so what again, whatever 101,000 divided by 279 is, that's how many days she'll get. I don't know what it is. Or she could get $11,000 cash payment, $279 a day. Again, elimination period for 30 days, but only $38,000 of lifetime benefits. So hold on just a second. I want to see if I can't find what she sent me because I want to show you, well, not show you, but I'll tell you how much your premiums are going up. Excuse me, it wasn't a 400% increase in premiums. It was only 372% increase. On basically she's already paying over $300 a month. 372% increase for that payment. Or if she had reduced payments, it would be only 196% increase. The hell's that? Freaking nuts, man. That's just wrong, dude. So she's in her mid-70s when she's most likely to start to need this thing, and they're going to say, well, thanks for making all these payments for all these many years, but sorry, we got to raise the premiums because we screwed up. That ain't right, dude. That's not right. It's not her fault. No, at the end of the day, what's she going to do? She's going to take option one, get that $101,000 pool of money. And again, we'll just say how much, let's say, so $101,000 pool of money. I can't bring the calculator. I guess it won't let me bring the calculator up. One sec, do I got to do it? Okay, there we go. $101,000 pool of money, divide that by 279. So she'll have, what's that, a year? Look at that, a year of payments, essentially, covered. How much would, just the absurdity of this is how much more would, 3,000, she's been paying this for years. If she would just put, and I get it, if this, she could have just left it in cash and it would be her money to use as well. This is what infuriates me because now that they got you when you're in your mid 70s and you're more likely to need it, now they're going to say, yeah, we screwed up, pay us more or get a reduced benefit. Just telling you like it is. All right, we'll see you.